Imagine buying a home only to learn a few years later that the neighborhood floods every hurricane season, wildfire risk is rising, or insurance companies are pulling out of the area. This scenario is becoming more common as climate change reshapes environmental risk across the United States and around the world. Yet in many real estate transactions, homebuyers still receive very little information about long-term climate risks associated with the property.
This presents an important environmental policy question. Should buyers be presented with climate risks when homes are sold?
Climate hazards are no longer distant projections. Communities are already experiencing more intense floods, stronger hurricanes, extreme heat, prolonged drought, and larger wildfires. These hazards affect not only safety and infrastructure, but also property values, insurance availability, and long-term financial stability.
Despite this growing reality, real estate disclosure laws often lag behind climate science. In many places, sellers are required to disclose issues like structural damage, mold, or past flooding. But they may not be required to disclose future climate risks, such as wildfire frequency, sea level rise, or increased flood risk.
As a result, buyers may unknowingly purchase homes in areas that will face significant environmental and financial risk over the coming decades.
This is where environmental policy becomes critical.
Several political institutions influence whether climate risk disclosure becomes standard practice. At the federal level, national governments influence housing finance, disaster management, and insurance policy. Federal agencies that oversee mortgages, flood insurance programs, and financial regulation can shape how climate risk information is incorporated into housing markets. At the state level, governments often have the most direct authority over real estate transactions.
States typically establish property disclosure laws, set insurance markets, and establish building codes.
If policymakers choose to update these disclosure rules, they could require sellers to inform buyers about climate-related hazards, such as wildfire zones, flood risks, or extreme heat exposure.
Local governments also play an important role.
Cities and counties control land use planning, zoning decisions, and development permits. They often maintain hazard maps that identify areas vulnerable to flooding, erosion, or wildfire.
Local policies can influence whether new developments are allowed to be developed in high-risk areas and whether those risks are clearly communicated to existing residents.
Finally, courts and legal systems help determine liability when climate risks are not disclosed. Legal cases involving property damage or misrepresentation can establish precedents that shape how much information must be shared during real estate transactions.
Together, these institutions help determine whether housing markets operate with full disclosure about environmental risk, or whether that information remains incomplete or unevenly distributed.
This policy debate is becoming increasingly urgent because climate risk is beginning to influence migration patterns. Some households are choosing to relocate away from areas facing repeated disasters, rising insurance costs, or declining infrastructure resilience.
Clear climate risk disclosure does not necessarily mean that people must move.
Instead, it empowers individuals, communities, and markets to make informed decisions about resilience, investment, and relocation. In the coming decades, environmental policy will play a key role in shaping how societies adapt to a changing climate. Ensuring transparency about climate risk in real estate markets is one important step toward helping people find safer and more resilient places to live.